Good morning, good afternoon, good evening. Let's start with the last topic of the part 2, that is retirement plans. In retirement plan, we are going to learn about 4 types of plans. First is self-employed plan. Second is simple IRA and simple 401k. Third is defined benefit. In defined benefit plan, we are going to qualified plans. We are going to have 2 types of plan. That is defined contribution plan and the second is defined benefit plan. Okay, so here you can see overall chart has been mentioned over here regarding the limits, like how much you can contribute. Out of that contribution, how much will be deductible, right? And up to what date the employer can contribute and set up the plan. So let's start in a stepwise manner. First, we are going to learn about SEP plan, that is self-employed retirement plan. Okay, for creating a self-employed IRA account, only a self-employed person can contribute for this plan. Okay, for example, if it's a sole proprietor or any individual person who wants to contribute for themselves, so they can contribute in a SEP IRA. Okay, and this type of plan can only be a traditional plan. See, as we all know, there are 2 types of plan, that is Roth. One is Roth and one is traditional. Okay, so to create a SEP IRA, self-employed plan, it cannot be a Roth, it has to be a traditional plan. Okay, employee will own and control, whoever is contributing will own and control this plan, will control this account. Employer can contribute to the financial institutions who maintains SEP IRA. Okay, so when to establish the plan? Up to the due date of the tax return, whatever is your due date, up to that date you can establish the plan. Okay, how it is established? Through a written agreement. Each eligible employee must receive the information and can be set up for each eligible employee. Who is the eligible employee in this case? Less restrictive requirements are there, it's not mandatory, but see, these conditions are not mandatory, but it is recommendatory that the employee should have the age of more than 21 years. Then he can set up a simple IRA plan. He should have worked at least for 3 years out of 5 years. Previous 5 years, he should have worked for 3 years. Then the employer can set up the self-employment plan for that employee. Minimum compensation should be $650. How much maximum contribution is required? So this limits will be changed each year according to the inflation. Okay, so just remember, for self-employed, the maximum contribution is $61,000 or 100% of your compensation, whichever is lower. But to calculate this maximum contribution, there is again one more calculation. First, you will take net profit. Okay, since you are a sole proprietor, you will just take the net profit from your business. You will reduce the self-employed tax, which is a deductible part. What is the deductible part of self-employment tax? It is simply 50%, right? 50% of the taxes paid is deductible. So take that amount. Okay, if this amount is 125, then 0.25%, 0.25 is how much? You will just reduce that much part, and whatever is your amount, you will multiply it by 25%. This much amount will be your contribution which you can deduct. Okay, I'll repeat again. Maximum contribution you can do is 61,000 or 100%, whichever is lower. But out of this, how much will be deductible? It is just the 25% of the contribution. Now this 25% will be calculated in what manner? By taking the net profit, reduce the self-employed tax, that is deductible. Okay, whatever tax, self-employed tax you have paid, 50% of it will be deductible. So net profit minus SE tax, whatever is the amount, you will consider that this is inclusive of the 25%. So this is your 125, right? Then what will be your 25%? So just come to that amount, whatever is the figure left out after reducing this 25% will be multiplied by 25%, and this will be your deduction allowed for the contribution. All right, so this is about self-employment plan. Self-employed taxpayer can contribute SEP IRA established on his or his own behalf, not as an employer. They will have to contribute on their own behalf, not as an employer. Okay. So this was about SEP IRA. In the table, you can see over here on the first page, the same thing is mentioned. The last day of contribution is due date of employer return plus extension if any. Okay. Up to the due date, you can contribute. What is the maximum? It is 61,000 or 25% of participants' compensation, whichever is lower. And maximum you can contribute a maximum compensation. See, here 25% of participants' compensation is mentioned. So what is the maximum compensation the participant will have? That is 2,90,000. Okay. Maximum deduction will be 25% of participants' compensation that we saw right now. How we are going to deduct the 25%? By taking the inclusive amount and reduce the 25%, and then whatever is the amount, just take the 25%. When to set up? Anytime you can set up the plan, okay, but before the due date of the return. So this was simple SEP, okay, self-employed plan. Next is simple IRA and simple 401k plan. Now let's see what is that. Okay, simple plan. Simple plan is nothing but a savings incentive match plan. Who are the eligible employee? Eligible employee is a person who is going to receive or has received $5,000 during 2 years plus current year. Okay, so that is very minimal account. For those employees who have received $5,000 during the 2 year plus current year are eligible to set up a simple plan, simple IRA or simple 401k plan. Employer can set up if they are having up to 100 employees in their organization, plus minimum compensation for those employees are more than $5,000. Okay, then the employer can set up the simple plan for the employees. Employee can choose to make salary reduction, or they can ask the employer to have a elective deduction. Mandatory non-elective contribution will be made from the employer based on the salary. This plan should be maintained and should not be withdrawn. If it is withdrawn before 2 years, then a 25% tax will be charged at flat rate. Okay, so simple plan is nothing but an employer which is going to set up a retirement plan for their employees if the employee are eligible employees. Who are eligible employees? If they receive 5,000 or more during the 2 year and current year as a compensation, and if the employer is having up to 100 employees plus minimum compensation is more than $5,000 for those employees. So those employer will set up a simple incentive plan, that is IRA, simple IRA or simple 401k. Okay, establishing a simple plan, they can establish it between 1st Jan to 10th of Jan. Okay, any date between 1st Jan to 10th Jan. If new employer is there who has set up some new corporation, new business, and that setup has started after Jan 10th, then they can come into existence after that date. Okay, normally you will have to establish it between 1st to 10th of Jan, first 10 days of the first year. Okay, notification is required. Employer will notify to the employees that they are no employee has the opportunity to make or change the choice. Employer's contribution method will be mentioned to the employees. Okay, summary description will be given regarding the whole plan. How much amount is contributed, till what date it will be contributed, everything, right? And written notice will be given about the balance transfer. Next is election period. Till what date you can elect is November 2nd to 31st December. Election period is 60 days prior to 1st Jan. Now we saw that the plan should be established between 1st Jan to 10th of Jan. So just before 60 days, the election should be made regarding which plan they need to set up. It's a simple IRA plan or a 401k plan, or what kind of plan is there. Okay, so that needs to be done before 60 days prior to 1st of Jan. That is, I can say between 2nd November to 31st December. Okay, what is the form number? Form is 5304. Simple plan that allows each plan participant to choose their own financial institution. And 5305 simple plan where employer requires the initial designated financial institution. Okay, they will initially designate a financial institution by way of form 5305, and 5304 is nothing but it allows the employee to participants to choose their own financial institution by filing 5304. So this was about simple plan. Okay, simple 401k plan. Contribution deadline are nothing but 30th after the end of each month. Each month you can contribute, right? If you have done the practical, then you can you have seen that there are some deduction, right, from the wages and salaries which is paid to the employees. So what employer will do, employer will deduct the amount for simple plan 401k plan from their wages, and it has to be deposited to the financial institution till the end of the month. Okay, from, you can say, contribution deadline is 30th after the end of the month. So for the month of January, whatever 401k and simple IRA amount has been deducted from the wages and salaries of the employees, that needs to be deposited till 30th of the next month. I can say 20th of the Feb. You will have to deposit it to the financial institution. Okay, this is about simple plan. Let's see from the chart again. Yeah, simple IRA or simple 401k plan. What is the last date of the contribution? Salary reduction 30 days after the end of the month. Matching or non-elective deferral contribution will be done till the due date of the employer return. Whatever salary reduction is done from the employee's salary, that needs to be deposited within 30 days. And whatever employer is contributing, that needs to be deposited till the due date of the employer's tax return. Okay. Maximum contribution is simple. If employee is contributing, then they can contribute 14,000 plus catch-up contribution. Catch-up means what? If your age is more than 50, then along with the 14,000, you have extra 3,000 to contribute. So maximum contribution, if your age is more than 50, is 17,000, right? Or else it is normally 14,000. How much employer can contribute? Employer can contribute 3% of the employee's compensation, or fixed 2% of the compensation. Here the maximum compensation is 3,05,000. Okay, employer can contribute up to 3% or fixed 2%. 3% is the matching. Like for example, if salary of wages of a particular employee, say 10,000. So 10,000 into 3% they will take, or they can take a 2% non-elective. Next is multiple plan. Employee is having participants in is participated in more than one employer plan, then employee can contribute maximum 20,500. If more than one plan are there, then overall you just add all the total plan and maximum contribution will be 20,500. An employer has the option to contribute up to 3%. Minimum 1% they will have to contribute. 3% is the highest amount I am saying. Okay. For maximum 2 years out of 5 years, you will have to contribute for at least 1% to 3%. Next is how much deduction you will get. Employee will get a deduction of 13. If it's an employee's contribution, then the deduction will be 13,500 plus catch-up. Catch-up means again, if age is more than 50, then you will get a 3,000 extra deduction. Employer deduction is whatever they have contributed, they will get 100% deduction. So you can see whatever is the contribution here, 3%, that 3% they will get as a deduction. Okay. Till what date this plan should be set up? It should be set up before 60 days, right? Or I can say the first week of the first year, 1st Jan to 10th of Jan. Okay. But if you have come into existence after 10th of Jan, anytime, then you can set up the plan after that date. So anytime between 1st Jan to 1st October, if employee has come into existence after 1st October, then as soon as feasible. Okay, so this was about SEP and simple IRA plan. Next important plan is qualified plan. If you can see in qualified plan, there are two types of plan, that is defined contribution plan and defined benefit plan. Defined contribution plan also, there are again two types. One is profit sharing plan and second is money purchase pension plan. Okay. If you can see here, defined contribution plan, profit sharing plan means there is no fixed amount. Okay. The amount that needs to be contributed is not fixed. But in money purchase pension plan, it's a fixed amount that is going to be contributed each pay scale, like each month. Okay, even if there is no profit, then also the employer will have to contribute if they have selected money purchase pension plan. So what is the last date for the contribution? If I talk about the qualified contribution plan, a defined contribution plan, elective deferral, if it's elective deferral, right, if the employer had decided to contribute certain percentage, then the due date of the employer return plus extension if any. Employer's contribution, if it's a money purchase or pension plan, then due date of the employer's return plus extension if any. So if I talk about the profit sharing plan or maybe money purchase pension plan, in both the cases, the due date for the last date of contribution is still the due date of the employer's tax return. How much is the maximum contribution they can make? It is 20,500 plus 6,500 if the age is more than 50. Okay. If I talk about money purchase pension plan, it is 61,000 or 100% of the compensation, whichever is lower. Okay. Out of this, how much deduction you are going to get for the contribution made? It is 25% of all participants' compensation. Okay, whatever is the participants' compensation, but maximum we will take 2,90,000 compensation per annum. Okay, so take 25% of all the compensation, that much deduction the employer will get, whatever amount he has contributed. Okay, how till what date you can set up the defined contribution plan? It is till the end of the tax year. Got it? This is very simple, guys. You just have to remember the limits and what are the last date of the contribution, what is the maximum deductions. Only this thing needs to be remembered. Next is defined benefit plan. Defined benefit plan is nothing but it is set up on quarterly basis. So at the end of each quarter, till 15th of the end of the quarter, you can contribute. Okay, so the due date is till the end of the quarter, 15th day. How much maximum you can contribute? It's 2,45,000 or 100% of the compensation. Now this compensation, we are going to take the average of the 3 years. Take 100% or 2,45,000, whichever is lower. How much will be the deduction? It will be based on actuarial assumption. You don't need to calculate it. It will be based on the actuarial assumptions. Until what date it will be set up? Till the end of the tax. So these were the 4 main type of plans, contribution like retirement plans. Okay, there is one more plan, that is 403B plan. This is for government employee. Okay, it's basically the tax shelter annuity retirement plan for the employees of a public school, tax exempt organization and certain ministers. And if you are a government employee, okay, then the employer, only the employer can set up this plan. Okay, employee themselves cannot go and set up a 403B plan. It's because they are only for eligible employees. Who are the eligible employees who can participate? Employee of a tax exempt organization, employee of a public school, employee of a corporate hospital service organization, right? This all employees can only participate in 403B plan, and only the employer can set it up, and then they will enroll their employees to that plan. Individual account in 403B plan can be annuity contract, it can be custodial account, okay, or it can be a retirement account. These 3 types of accounts can be maintained in 403B plan. What are the limits? How much contribution can be made in this? Annually, you can contribute 58,000 or 100% of the compensation, whichever is lower. Okay. Now, the employer can elect to defer, right? Deferral compensation can be made, that is 19,500 maximum plus 3,000 if more than 15 years service is provided, plus 6,500 if your age is more than 50 years. Okay, so total 19,500 plus 3,000 plus 6,500 can be made as a maximum contribution in the 403B plan. Okay, and this plan is set up by the government only. So that's it. That these are the types of plan. There is nothing important in it. You just remember the limits. Now, can you provide a loan from your retirement plan accounts? Okay. Maximum amount that plan permit as a loan is the greater of 10,000 or 50% of the vested account balance, whichever is higher. Up to that amount, the loan is permitted from the qualified plan. I'm talking about this, okay? Qualified plan, maximum this much amount you can be permitted as a loan. The loan amount should be up to 50,000 and the loan should be repaid within 5 years. Then it will be considered as a non-taxable contribution or distribution. Okay. Next is prohibited transactions. What transactions are prohibited? Between the plan and the taxpayer, beneficiary, disqualified person. Okay. Between the plan and the taxpayer, or the beneficiary or a disqualified person. Transfer or use of a planned income or asset for the benefit of disqualified person. Any act of fiduciary which deals with the plan, right? In if they want to sell the assets or they are utilizing the income for the benefit of a disqualified person, right? Receipt of consideration by fiduciary in their own account, receiving unreasonable compensation, and any act between the plan and a disqualified person which involves selling, exchanging or leasing of property, lending of money or extending the credit, furnishing the goods or services or facilities. Okay, so these 5 transactions are prohibited transactions. Who will be considered as a disqualified person? Here is the list provided, just go through it. It's nothing but the a person other than the beneficiary will be a disqualified person. Who is having a direct or indirect relationship, or more than 50% holding is there, more than 10% partner is there, officer, director who is having more than 10% shareholding, or highly compensated employee. HCE means highly compensated employee. Okay, so these persons are disqualified person. If you are a disqualified, then what will happen? You will have to pay a 15% tax on the prohibited transaction. If the 15% is not paid, then the additional 100% of the amount, whatever is involved in the transactions, will have to be paid as a penalty. Okay, this is about the retirement plan. Next is reporting requirement. So there are 2 types of reporting requirement. First is form 5500 SF and second is 5500 EZ. If all the conditions are satisfied, if you are having a small plan, means your participants are up to 100, you are exempt from a qualified public audit, your plan assets are 100% invested in the secure investment, and no employer securities are there, and not a multiple employer plan. Okay, if all these conditions are satisfied, you will be filing form 5500 SF, annual return, which is, and the due date is last day of the 7th month, that is 31st of July. Okay, 5500 EZ is nothing but one participant plan, only owner or the business owner uses it, right? Self-employed, I can say. Total assets are up to 2,50,000 and it is only for the final plan year, like in the year of distribution. Whenever the distributions are made from the plan, in that year you will have to file 5500 EZ. This is the reporting requirement to IRS. Okay, so yeah, in part 2 only this type of plans will come. In part 1 you might have already done, or you will be doing in the part 1, that types of IRA account, how much is contribution, how much will be distributed, how much is allowed, how much is disallowed. Okay, but with the point of view of part 2, you have to just go through only these 4 topics, and that's it. Solve all the MCQs as much as possible. So that's it for the last chapter, retirement plan. Okay, thank you guys.